Hello, I'm your professor, Dr. Stephen Haggard, and today I'd like to talk to you about the relationship between entrepreneurs and debt. If you're an entrepreneur, you probably have some sort of love-hate relationship with debt. If you're an entrepreneur and you don't have partners and you're not incorporated, then the only source of equity that you have for your firm is your own personal wealth or any sort of profits that you've been able to plow back into the firm. And so that means if you want to grow the firm, you're probably going to have to take on debt. And so from that perspective, you've got a necessity to have debt, but there are a lot of downsides to debt. So let's talk about those sorts of things. First of all, let's talk about the upsides. With debt, we know that interest is tax deductible, which is helpful. However, with the recent change in the tax code, maybe it's not as helpful as it used to be, since tax rates generally for businesses have gone down. We also know that debt has a control benefit. Now, what do we mean by that? Think about if you were to take on a partner for your business. Now you have had to give up some control. And also you've had to now share the profits of the business with a partner. People really don't like to share and they don't like to give up control, so these are not things that people really like to do. And so that's another downside of equity that you don't have with debt. Of course, with debt you have to pay interest, but it's a fixed amount. You don't have to share a percentage of the gains. And there's also a disciplining effect to debt that a lot of people overlook. And that disciplining effect is basically due to these periodic fixed payments. The entrepreneur knows that they have to produce a certain amount of cash flow in order to be able to make these fixed payments. And so it really does a good job of keeping the entrepreneur from slacking, in other words, not working. Or it also keeps them from squandering the firm's funds when times are good, because they will need to continue to make these debt payments. In fact, I saw a bumper sticker one time that nicely illustrates this disciplining effect of debt. It was a twist on that song from Snow White and the Seven Dwarfs. It was, I-O, I-O, it's off to work I go. I thought that was a pretty good illustration of the disciplining effect of debt. Now there's an upside for entrepreneurs to debt that is a downside to other folks perhaps, and that is the ability to gamble with other people's money. Now what are we talking about here? You've got a project, you don't know whether or not it's going to succeed, so instead of investing your own money, you borrow someone else's money and you do the project. If the project succeeds, you merely pay them the money that you owe, which is a fixed amount, and you get to keep all the leftovers. However, if things go sideways, then you just walk away and you leave the lender holding the bag. Now obviously that's bad for the lender, but it was good for you as an entrepreneur. And so that's an option provided by debt that is not provided by equity. Now, what are the downsides for you as an entrepreneur? First of all, debt can be addictive. It's a whole lot easier if you can find someone willing to loan you the money. It's a whole lot easier to borrow money than it is to go out and make money, than it is to streamline your operations or grow your business organically. That requires work and smarts and effort, and it's just so much easier to just borrow money. And if you don't believe me, just ask the United States government. Debt is addictive. And there's another problem with debt, and that is it makes you feel momentarily richer when you've been given a large amount of money by a lender. I knew a man growing up in my hometown. He was a businessman, and he was constantly flirting with bankruptcy. Every time we heard something about this man, it was always how he was on the edge of bankruptcy. But he always managed to find someone to loan him some more money. And whenever that happened, instead of going around and paying off old debts immediately and then thinking about what to do with the remaining money, the first thing that he would do is take his wife out for an extravagant dinner. And this happened over and over and over again. And so it can be a problem. We call this the diminishing marginal utility of consumption. When you've got a lot of money, whether it's yours or borrowed, that makes you think that each dollar is worth less. And so you spend that money differently than you would if you had less of it. And so you momentarily feel richer when someone gives you this money, and so as a result, you go out and spend perhaps foolishly. And then there's the big one, the threat of bankruptcy. We know that as debt increases, so does the threat of bankruptcy. And that comes about primarily because of the size of the fixed debt payments that are required and fixed in amount and periodicity as a result of taking on the debt. If you don't owe anybody any money whatsoever, there's no way you can go bankrupt. So that's the good news. But each additional dollar of debt that you take on raises the probability of you going bankrupt. And the higher these fixed payments are, the more likely you are to go bankrupt. But it's not just the size of the debt payments compared to the average cash inflow. We also need to look at the volatility of that cash flow. In other words, we could have two businesses, one that has a very smooth month-to-month cash flow in, and one whose cash flow varies quite a bit by month. And we would see that the one with the smooth cash flows would be able to take on a much larger proportion of their capital structure as debt, because there is a lower likelihood that their cash flows are going to drop below the amount needed to cover those fixed periodic payments. Whereas the firm with volatile cash flows has a much higher likelihood of having their cash inflows drop below that fixed monthly payment, and therefore raising the specter of bankruptcy. We can see this with professions. For example, let's think about a government worker that receives the same salary every month, and it's pretty hard to get fired or laid off from a government job. And so that person could depend on debt quite a bit more than, say, a farmer who is dependent on the weather and the next crop size to determine their incoming cash flows. Now, I'm speaking of the farmers that I grew up around. They hated debt. And the reason they hated debt was because it raised the risk, because their cash flows in were so volatile. Now, it's my understanding that farmers these days depend on quite a bit more debt, and I think the only reason they're able to do that is because of crop insurance, which helps them to avoid bankruptcy in the case of a failed crop. You could think of other kinds of businesses. For instance, a home builder. A custom home builder. He might get one home this year, and he might get 3 homes next year. And so the cash inflows would be very volatile, and therefore he might be less likely to depend on debt. Of course, each individual house that he builds, he will be borrowing money to build those, but as far as his own personal financing of the assets that he owns, probably will use more equity than, say, a government worker with a steady monthly salary. So now let's put this in terms of businesses. Let's think about different businesses and the volatility of their cash flows and what percentage of debt you might expect to see in their capital structures. Let's start with banks. Banks run on about 90% debt and 10% equity. And the reason that banks can do this, there are actually a couple of reasons. Number one is that they have these very well diversified portfolio of assets, primarily loans. They're not loaning all their money to one client. They're not even loaning all their money to clients in one industry. And so they've got very well diversified portfolio of assets. And number two, they're in a regulated industry. And so they're really constrained from making some Now, we know that banks do make bad decisions, but they are more constrained at making bad decisions than perhaps they would be without regulation. So these things kind of come together to help make banks where they can depend more heavily on debt. Now let's talk about electric utilities, companies that make and sell electricity. We see that they run on about 60% debt and 40% equity. And once again, it's a regulated industry, but we see that there's seasonality in their cash flows. Of course, in the summertime, when air conditioners are running high, you'll see they get large cash flows, and maybe not so much in the wintertime. Also, we see that their fuel prices, their prices of their input, are probably more volatile, and we don't know what the weather's going to be like. And so maybe if we have a mild summer, their cash inflows will not be as great, or if we have a harsh winter, their winter cash flows will be increased over normal. And so what this means is that their cash flows are more volatile, therefore they cannot have as much debt in their capital structure without risking bankruptcy. Okay, so now let's get down to you and your business. How much debt should you be using? Well, in finance, we typically say that what you want to do is look at the industry average. So let's assume that you are in the fertilizer business. You've got a small business where you make and sell fertilizer. How would you figure out how much debt you should have in your capital structure? Well, what I would do is go out and look at other firms in the industry that are publicly listed. And you'll be surprised how many firms there are in different industries that are listed. And you go out and you can look at their financial statements through SEC EDGAR, which is the electronic data gathering and retrievable. I forget. Yeah, it's EDGAR. So if you put in SEC EDGAR, you can find it. Or you can go to Yahoo Finance and see their financial statements. That's probably easier. And you can figure out what is the total debt ratio on average in the industry. Now, if you see a bunch of them that are very similar and you see one that's way off, throw the one that's way off out. There's probably something weird going on with that particular observation. But then take the average of the rest of them and make that your target capital structure. With one caveat, one caution here, and that is you need to consider your own risk aversion. Now, as an entrepreneur, you are probably less risk averse than people who choose to work for someone else and get a steady paycheck. But we would still expect variation in risk aversion between different entrepreneurs. And if you are more risk averse, then you should operate with a lower level of debt. Now, in the end, you're going to make less money this way. However, getting rich is a luxury. Sleeping is a necessity. If you like the video, please subscribe, hit the like button, and you could also click on that little bell if you want to know when I post a new video. And if you want to see a video on a given topic, just go ahead and send me a message in the comments, and I'll be glad to consider making a video on your topic. Thanks.